Good afternoon, everyone. Thank you for joining us for Secure 2.0, Reshaping the Retirement Landscape. I have just a few announcements. For those of you who are requesting credit, please note that to receive CE credit, you must remain logged into the video portion of the webinar for the entire program. Logging into the audio portion only is not sufficient for CE credit. Continuing education credits are being offered for the following designations: CPE, CIMA, CPWA, CIMC, RMA, CFP, and SHRM. Also, at the end of the webinar, we would like to request that all attendees fill out the evaluation form that will pop up. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can, but we want to be respectful of your schedule and end on time. If we don't get to your question today, we will definitely follow up with you afterwards. Tomorrow you will receive tomorrow you'll receive an email with a link to replay today's broadcast. Let's get started. Today we are joined by Rich Rouser, Senior Vice President of Thought Leadership Practice Management at Pentegra. Rich has more than 30 years of experience in the retirement benefits industry and is responsible for helping to shape and define Pentegra's viewpoint on workplace retirement plans, plan design strategy, retirement success, and employee savings trends. Rich, I will now hand things off to you.
Lizzie, thank you very much, and thanks everybody for attending today. I appreciate that. As Lizzie mentioned, we're offering this for continuing education credit, so we do actually have to go to, for the full hour. So we're going to run a full additional 59 minutes or so for the presentation. And again, we do have a couple of polling questions that are going to come up during the presentation. So to start off, we're going to go over some of the background of the new law, how we got where we are today. I'll give you some opinions as to why I almost thought we would have gotten there before today, but it is what it is, right? We're going to go over the various employer-sponsored plan provisions. I note that there are other provisions contained in Secure 2.0 that are not really directly retirement plan related, but they're interesting nonetheless, and they come up at the very end of this presentation today. And again, we'll go through some of the other provisions and some of the, I call it the Department of Labor and IRS homework that needs to be done, and hopefully a conclusion towards the end of the presentation. Some of the things that we're going to talk about today are some of the emergency savings features that are in the new law. There's a couple of different ways they kind of come at that. Student loan matching contributions are certainly a hot topic this day and age. And I know one of the other provisions that is of great interest to a lot of people is what I call the Rothification of 401ks and 403bs, where various matching contributions and or employer contributions can go into the plan as a Roth type contribution, which is very interesting to say the least. And again, we'll go over some other provisions impacting multiple employer plans, which are MEPs and PEPs and what we used to call GOPS, group of plans, as well as they now call them really DCGs, defined contribution groups. I'm going to talk a lot today about some of the effective dates. And I think actually before I go one more slide here, let me just spend a half a second on effective dates. It's, I think, critically important to truly understand the effective date of each provision, because throughout this new law, and again, I think there was something like 358 pages of new law contained in the 4,155 page Omnibus Act that was passed late last year. So, but effective dates, they come in a couple of different varieties, right? Some of the effective dates are impacting periods of time prior to the enactment of Secure 2.0. The enactment date, for reference, was December 29th of last year, 2022. Some of the provisions in this new law are effective on or after, right, the enactment date. Some are effective after, right, to distinguish it from on or after. Some are effective for, they'll use terminology like plan years beginning after the enactment date, or even tax years of whether it's an individual tax year or a corporate entity type of a tax year. So again, it's critically important to truly understand how the effective dates come into play and what they really mean, because as they say in this case, a day does make a difference on some of this. So some of the background on the new law: and we knew this, anybody who's tuned into some of the webinars that we've presented here at Integra for the past couple of years, you would know that we discussed all of these prior proposed pieces of legislation, starting with Securing a Strong Retirement Act of 2021. That piece passed the full House back in March of 2022. It had 51 various provisions. Then there was the middle one on this slide, the Rise and Shine Act, that had 26 provisions, and that passed the Senate Health, Education, Labor, and Pensions Committee back in June of last year. And then there was the EARN Act that contained 70 provisions, and that got through a Senate Finance Committee last June also. So, these are the major pieces of proposed legislation that were folded together and that became Secure 2.0 essentially. Final version of the law is not always 100% in line with what was in these various other provisions, and I think there are a couple of other surprises thrown in along the way. So the theme, and again, we've known this, those of us who have been in the retirement industry for years have known that the initiative, at least the governmental initiative, has been to expand retirement plan coverage in the United States, increase retirement savings, preserve retirement income, and the last one, which helps quite a bit in terms of service providers, number one, simplifying and clarifying retirement plan rules, also helping plan sponsors as well as plan participants, quite frankly, because there were quite a few rules that were, I will say, convoluted at best, detrimental in some cases, and just simply needed clarification to really do them proper justice. So with that said, we'll get into some of the main provisions of the new law. So one of the things is some changes to tax credits for new plan formation. I think highlighting the most impacted area for smaller plans, 50 or fewer participants. Essentially, the startup credit was increased from 50% to 100%, which is a good thing. And for employers who are startups but larger than 50 but less than 100, that credit phases down from 100%. It tapers down a bit. So, but the good news is that credit has been enhanced for new plan formation. The second bullet talks about an additional credit of up to $1,000 per employee, right, for certain employer contributions, and again, primarily impacting the 50 or fewer piece of the market. So again, this enhancement is effective for taxable years beginning after 12/31/22. Again, that's another variation of how they're talking about effective dates. Tax year, obviously number one, and number two after year-end 2022. So the next one is kind of an interesting one, and talks about automatic enrollment in 401k and 403b plans. So the way this would work is that year one auto enrollment would be at least 3% and up to 10%, and then there's an auto escalation aspect of it. It goes up 1% each year until it gets to at least 10% salary deferral, but not more than 15%. And again, as always with auto anything, participants can opt out or elect a different percentage. This bullet says existing plans exempt. I'm going to come back and spend a minute on that because I think that's critically important to understand. Other exceptions apply, and I'll give you some details. Now, in general, right, in terms of when this feature actually has to be in play, it's for plan years beginning after December 31 of 2024. So generally speaking, in 2025. Now, when we say here that I think the phrase was existing plans are exempt. Well, what that really means is plans that were adopted prior to the date of enactment, prior to December 29, 2022, are exempt from the requirement. To the extent that a new plan is adopted after date of enactment, put it that way, now, today, whatever, up through the end of this year, up through the end of even 2024, the plan technically does not have to have auto escalation or auto enrollment until the plan you're beginning in 2025, right? So, even for an employer that quote unquote adopted a new plan effective January 1 of this year, when we say existing plans exempt, that one really is not exempt. It really is a function of, was that plan adopted or in effect prior to the date of enactment of the new law? So just so there's no surprises there. So auto enroll and auto escalation would come into play in 2025. The other thing is when we say exceptions apply, there are exceptions in the law, this new law, that says if you're a small employer, and generally that's 10 or fewer, participants, or if you're a new business, right? If the business sponsoring the plan has been around for less than 3 years, you don't need to adopt the auto features mandated by the law. And I guess, one other aspect to think about, if a plan is merging into a MEP, a multiple employer plan, or a PEP, pooled employer plan, the fact that that plan might have been in existence prior to, it's a single employer plan prior to the date of enactment of the new law, that doesn't matter, right? If you join the MEP or PEP, essentially auto enrollment and auto escalation of contributions is going to come into play, again, unless you meet one of those exceptions as a small business or as a new employer who's been around for less than 3 years. Okay. So there was a lot to say about those that little piece of legislation, but I just want to make sure it's not confused because it is a little bit complicated based upon the date of establishment of the plan. Okay, so a couple of other things that are in the new law, and these are a couple of provisions that are all technically effective now, 2023. The first one allows small, immediate financial incentives. We call that a low-value gift card of some sort for contributing to the plan. That's to entice or encourage participants to, who knows what, come to a meeting to talk about how the plan would work and how the plan would benefit them. Or to encourage them to sign up. Please sign up for the plan. Here's a gift card. So effective technically now. Just one little fact here, right? You can't use plan assets to provide that gift to that employee, to that participant. That's got to be provided by some other source other than plan assets. There's a tax credit for small employers who cover military spouses in retirement plans. There is a provision that permits employers of domestic employees to provide certain SEP IRA type contributions. And the last one I'm really not going to speak about today. I don't know that many of us interact with rural electric cooperative plans, so I'll go past that one pretty quickly. And if you have an interest in that, we can talk later. So a couple of other things that are effective in 2023, QLACs. Qualified life annuity. These are basically annuity contracts that begin at a later age. I think they begin as late as age 85. There was a lower limitation on the amount that a participant could put into that type of an annuity contract. And now it's been increased up to about $200,000 per year, which is kind of the good news. It gives a little bit more headroom. So really, again, I'm not going to go into depth into what this thing really means, but it really is a type of an annuity contract that arguably could let a participant spend down the rest of their assets with the knowledge that they purchased this long-term annuity contract that starts to pay off much later in life, and that there'd be some source of income later on. So it helps people figure out their spending and planning needs in retirement, so to speak. The second bullet on this slide talks about tax-preferred retirement accounts that may have an annuity in it, and there was some anomalies in the law where required minimum distributions, could have been hard. I wouldn't say hard to determine, but they didn't take into consideration the annuity portion of the distribution of the participant when calculating the RMD. So people were kind of being forced to take out, in my view, too much as a required minimum distribution. and this essentially allows aggregation of the two portions of the account and to take that into consideration in terms of calculating the remaining required minimum distribution. The last bullet, we see this more often in the defined benefit arena, where there might have been a mistake in payment or maybe an overpayment of some sort to a beneficiary in a defined benefit plan. And this provision is just really kind of relief for a plan sponsor, saying that since that plan sponsor doesn't have to aggressively go after an overpayment to a beneficiary in that plan, it gives them a little bit of fiduciary relief. And, at the end of the day, most defined benefit plans are fully funded by the plan sponsor. So to the extent that there might have been a mistaken overpayment to an individual, it really ultimately is going to come out of typically come out of the employer's pocket, so to speak, in terms of stepping up funding for that mistake. Good. So again, we've got, and by the way, just kind of as the backdrop to all this, of the 90 plus provisions in Secure 2.0, just about half of them are effective either immediately, meaning now or in 2023, and some are even effective a bit retroactively. And the other half of the provisions are effective in 2024 and later years. So there's a bunch that are effective now or will be effective now. Most of the features, I think, as a general statement, are I'll say optional. There are definitely some mandatory changes, obviously, but a lot of the features are optional. So as we go through this, just keep that in mind in terms of some will be required and some not required to be adopted. There's an expansion of the employee plans compliance resolution system. There was an elimination of a kind of a voluntary program. So this kind of ties into, I would say, codifying a mechanism to do certain self-corrections, due to primarily, I think, due to the elimination of the other program. There was a minor change, maybe a significant change, to governmental 457B plans with respect to making certain deferral elections. You can see the details up in the slide. I'm not going to go too deeply into that, since that's probably not the main focus of today's discussion. This is an interesting one. Top bullet on this slide: the employer plan sponsor may rely on the employee self-certifying hardship, that hardship conditions have been met. And this is, technically effective now, right? Plan years, well, in most plans, for most calendar year plans, certainly it would be effective now. But, I guess, there is just kind of a couple of pointers on this, right? Most plans that permit hardship distributions have a set of, a process, a procedure, and a set of controls that are in place to make sure that only legally permissible hardship distributions are actually processed in the plan. And, that's done for a number of reasons, right? Number one, to do the right thing under the law, the rules and the regulations. Number two, do the right thing from a plan sponsor standpoint, right, to administer the plan properly and correctly. And number three, grant the correct hardships to participants in need. So the fact that that's being changed to self-certification, we've gotten a fair number of questions on, like, well, great, how do we do that? When can we do that? Well, in my view, that's going to take a bit of a review of current process, procedures, and controls. And there's also, and by the way, right, because think about it, right, if you're changing how that occurs, participants need a different form to make an election, because they're no longer going to have to provide documentation as to the financial need. But that form's got to be redesigned, and obviously there's no guidance out on any of this yet, but redesigned to basically have them attest to the fact that they're taking bona fide hardship distribution, that they recognize what the law says, so on and so forth. So what does that mean? In my mind, there's going to be more disclosure required to the participant around the requirements to commence a hardship distribution. There's also something in the new law that basically says, well, gee, what if an employer, plan sponsor, has intimate knowledge that the participant technically does not qualify legally for that hardship distribution? Do they have to accept that participant's self-certification? So I think it's I think it's the IRS that's been charged with creating, potentially creating, right, a rule or regulation around, well, what do you do in that case if you've got knowledge to the contrary? Can you avoid that participant self-certification? So again, there are a couple of unknowns with this. I think it could be relatively easy to put in place. However, I think a thorough thinking through of what I call process, procedures, and controls is going to be necessary to effectively adopt that feature and that provision. Second bullet on this slide talks about retroactive first-year elective deferrals for sole proprietors and certain single participant LLCs. Again, I don't know if there's a huge interest in this provision for this group, but what this really means is, right, a couple of years ago, the original Secure Act permitted retroactive adoption of qualified plans. So right now in 2023 and up through any extended tax filing deadline for whatever tax return I had for last year, I could adopt a new plan for last year retroactively. But if I was a sole proprietor or just a one-person LLC of some sort, I could have adopted a defined benefit plan for last year at this late date. I could have adopted a profit sharing plan, but I could not necessarily have funded a retroactive salary deferral, elective deferral for last year. So this change in law would permit that. So in my mind, this is a huge benefit to those small situations that are installing a brand new plan on a retroactive basis. So it's a little bit of or a lot maybe of relief for them to be able to go back and do that at that point. Here's a couple of other things coming up this year. The first one talks about eliminating unnecessary plan notices for unenrolled but otherwise eligible employees. And, sounds kind of simple on the surface, but as with a lot of this stuff, it takes a little bit of thought, right? There are certain requirements that, for example, one minor example, you've got to make sure you give a summary plan description to unenrolled participants. As this heading says, you still have to provide an annual reminder. And there's some other language in the law that says, well, you've got to be able to produce and give to those unenrolled participants any of the otherwise required material if they so ask for, if they ask for that. So again, I think this is designed to take the burden off of plan sponsors from having to send out reams of paper to a lot of unenrolled participants who have not enrolled in the past and may never enroll in the future. And it tries to simplify it a bit, right, in terms of slimming down the annual notice to just, hey, a reminder that there's a plan here for your benefit. So again, it'll take a little bit of thought in terms of making sure that the appropriate people do in fact get the notices, and that you've got a way to kind of segregate quote unquote unenrolled participants who have otherwise received the required material. The provision on the right side of this slide, right-hand side in the blue box, applies to private sector firefighters. I'm really not going to go into detail on that today, but just know that it's there if you have a situation that involves that. A couple of bullets on this slide are not necessarily widely used or widely we don't normally get into the details of public safety officers and certain other groups that are impacted by these, I'll call these liberalization of the rules. So again, just know that those liberalizations are there is the point, and if you have a particular need, we can certainly speak to those points at a later date. The top bullet on this slide, I think, is probably one of the most talked about provisions of the new law. This is what I might have referred to earlier as Rothification of a 401k or even 403b type plan, effective after the enactment of Secure 2.0. And essentially what this says is the plan, or I should say plan sponsor, can give an option to participants that they can treat matching contributions as Roth contributions or certain non-elective contributions as Roth contributions. So that's what the law says. Now, the law also says, by the way, that you can only do that, plan sponsor, employer can only do that if that participant is 100% vested in their match or their non-elective contribution account. So, that opens up a couple of questions, right? Is that in essence implying that, gee, I can only offer this feature if my plan contains a 100% immediate vesting schedule on one or both of those contribution sources? Or is it possible to implement this feature for a plan that has a vesting schedule, call it maybe a 6-year graded, 3-year, cliff or 2-year cliff vesting schedule, whatever it may be, except, I can only really permit people to opt in if they're already 100% vested, right? So you can see that already it's creating a couple of, gee, what if this, what if that? And obviously, if a plan sponsor is offering this feature to people who are fully vested, some who are not fully vested, there's got to be mechanisms in place to track the status of each of those participants to make sure that somebody who is not fully vested is not opting to take that, get their contributions as Roth contributions. So in my mind, again, it's one of those things that's effective immediately. There's no guidance other than what's written in the law. So in my view, right, a reasonable interpretation of how that's going to work would be acceptable. But here are some other factors to consider, right? When I think about the various record keepers out there, right, who have record keeping software that track these various types of contributions, in my mind, most of those record keepers are going to have to reprogram their systems to be able to have a Roth source, a matching contribution in a Roth source, right? Because that has not really been, it's not typical. It's not been there in the past. So even though it's interesting, even though the law says you can do it this year, I'm not quite sure how anybody is going to do that right now today until those record keeping systems, are reprogrammed, software is adjusted, so on and so forth. Plus, there's got to be a new series of disclosures and forms and election forms and so on and so forth that need to be set up. And I guess, the other side of the equation is there's nothing in the new law that talks about, well, gee, how is the employee taxed on those Roth contributions, right? Presumably, if that employer is making a Roth match to my account, Roth money goes in on an after-tax basis. So the assumption is that employer is going to want to take a tax deduction for the contribution made to the plan, just like they always have. And therefore, almost like a participant converting a contribution to Roth inside of a plan, that there'd be an immediate taxation of that amount to the employee participant. So again, law doesn't talk about, gee, how is that taxable amount reported? In my mind, that's probably going to be reported on W-2, but I can think of scenarios where, maybe I terminated employment December 31 of last year, and now mid-year this year, the employer says, oh, we're going to do a discretionary match for last year. And Rich had opted to do his match as a Roth. And so they put it in for last year. Great. Technically, it counts as a 2022 contribution. My last W-2, since I terminated employment, is for last year. And that would have been done by the end of January of this year. You can see where I'm going with this. And now what do we do? Do I get a revised W-2 for last year, or is that somehow taxable in 2020? There's no rules around this, I guess, is my point. On the other hand, there could be guidance that says, well, all of this is reported on Form 1099-R. So look, it's great that feature is there. There are half a dozen questions or more that I've come up with that are, that kind of point to some of the complexities that the new law did not explain. And we can make a reasonable conjecture as to how that would work. But, if you said, hey, let's implement that today, again, even if we make a reasonable interpretation in terms of how it works, if the record keeper software is not already, all set to accommodate that, that's going to preclude you from adopting that right away and immediately. Anyway, I think we spent enough time on that one for right now. We'll move on to a couple of others. The middle of this page talks about the employer's ability to use assets from overfunded, typically defined benefit plans to pay for retiree health and life insurance. Boy, there's a delayed effective date. Well, I shouldn't say the delayed effective date. They can use that benefit up through 2032. Tribal courts is another one. We're not going to talk about that one today. So on the next slide, we've got a couple of more provisions effective either immediately or retroactively. The first one removes required minimum distribution barriers of certain life annuities. I mean, there could have been scenarios where somebody took a life annuity where the amount of that was maybe not sufficient to cover the required minimum distribution amount. So to me, that's kind of a clarification in how things work. There is a reduction. The middle one is interesting, a reduction for failure to take RMDs. The penalty tax has always been 50%, I think, since the beginning of time on this provision. That's been reduced to 25%. And if a participant, I shouldn't say a participant, if an individual, right, because it's ultimately the individual who may fail to take the RMD, if they do a timely, quote unquote, timely correction, that penalty can be further reduced to only 10%. So that I think is welcome relief. Certainly, I think because of the anomalies over the last couple of years, right, CARES Act in particular, which did not require, right, waive the requirement to take an RMD for 2020. RMDs resumed under law, as I recall, in 2021, and certainly in 2022. But I think we have found a number of participants who, in various plans, have shut off their RMDs in 2020 and, forgot to take an RMD in 2021 because they didn't reactivate the automatic calculation of their RMD. So anyway, but the problem is this relief really is only effective for taxable years beginning after after date of enactment of Secure 2.0. And for most practical purposes, that'll be 2023. The last bullet on this slide limits the repayment of qualified birth or adoption distributions to a 3-year period. That was one of the things we saw in the CARES Act that permitted those distributions, but unlike some of the other in-service, there was the hardship aspect of CARES Act that, if you were going to repay that, right, you had to do it within 3 years. Surprisingly, there was no repayment period on the distributions due to qualified birth or adoption distributions. So this just, in my mind, kind of tightened up probably what they should have had in the CARES Act to begin with. All right, moving on to a couple of other provisions. Let's see. Let me pick out the best one on this page. Oh, I think the one we're going to focus on is the last bullet on this page, the RMD. Big news. RMD age is now age 73. If you would be eligible to take, if you haven't previously been required to do an RMD, age 73 is the new age 72, which was the new age 70 and a half, as you recall, right? They've been pushing this age up for a couple of years now, pushing the age up for a couple of years. And you can see by 2033, that age will go up to age 75 as the RMD age. And I think this is done for a number of reasons. Number one, it preserves more money in a tax-deferred, or in the case of a Roth type account, tax-free type of a retirement account. And doesn't force people to take money out of the plan. Now, the one thing I will say that I didn't say yet is a lot of the features in Secure 2.0 are really costing the government money, right? I mean, this is one feature that will delay the receipt of tax revenue. If people are waiting until later ages to take money out of the plan, that's revenue that is not coming to the government now. So, I haven't seen a total in terms of what this bill or this legislation will cost, so to speak, but I got to imagine it's a pretty big number in terms of the additional tax benefits that are being afforded to companies that sponsor the plans, as well as the participants who are who are in these plans. All right, so in line with RMDs, there were some modifications to special needs trusts. There was an adjustment to a statute of limitations for the excise tax on IRA excess contributions and missed RMDs. We talked about a piece of that a slide ago. And there's a penalty, tax penalty exemption, for federal qualified federal disaster distributions. And we've seen this relief in that last bullet in a couple of most recently. Well, I'm not going to remember the name of the legislation, but there have been a couple of quote unquote disasters over the last couple of years where special relief was afforded. So this is codifying the definition of what these federal disaster distributions are all about, and I think making it more clear so that when the federal government declares a disaster in the on or after, you can see January 26th of 2021, right? Declared on or after that date, it automatically is known that this is what the situation is going to be. And I think they picked that date in particular because of the specific disaster that had either just concluded, so to speak, or maybe just before. I don't remember exactly. Hey, Lizzie, we have our first of three questions. So if you want to do this one, the question here is: the penalty for failure to take an RMD is changing from 50% to what percentage? So it looks like Lizzie has opened the poll. We'll give you, 20 or 30 seconds to hopefully respond. As Lizzie mentioned earlier, in order to qualify to get credit, you've got to, I think, participate in the three polling questions. That way we can kind of track, and those are the requirements that are imposed by us, by the organizations granting credit, by the way. So anyway, the answers are either 5%, 20%, 25%, or 40%. Lizzie, I don't know if you've got a good cross section. If you want to keep it open a little longer, that's fine.
Yep, thank you, Rich. I'll keep it open for about another 15 seconds for anyone who hasn't selected an answer.
And
all right, the poll is now closed. Yep, we're all good. And it looks like about 3% selected 5%, 13% selected 20%, 75% selected 25%, and 10% selected 40%. And the correct answer is C, 25%.
Yep, good. And yeah, that was, again, that was the 50% excise tax on failures to take an RMD. They moved that down to 25%. And again, there's, if you timely self-report your error, that can be further reduced to 10%. So a lot of numbers on the screen, I get it, but the most popular answer was in fact correct, which is C, 25%. That's good. I think on this slide, I'm going to talk about the second bullet for, in particular, which talks about an increase in the cash out limit, right? So plan sponsors can force cash outs for small distributions, small benefits under the terms of their plan. And that limit or that threshold has been, as long as I can remember, $5,000, right? If the account value was less than $5K, the employer could force a distribution out to the participant or to a basically force the cash out from the plan. Let's put it that way. So that's been increased to $7,000, and that a little bit of a delayed effective date on that, delayed until after calendar year 2023 is the effective date on that piece. All right. So there's a provision in the new law that talks about starter 401k and 403b plans. There are certain features that go into that, including an automatic deferral of at least 3% to 15% up to the IRA contribution limit. So we won't go into too much detail on that today, except that you should know that it's available and it's out there. What else? We're going to go another slide here. Okay. So there were a couple of versions of emergency savings accounts added to the new law or incorporated in the new law. And one of them is, I kind of call this an emergency sidecar account. So you can add a pension-linked emergency savings account, right? You can offer it in your plan to non-highly compensated employees. You can actually auto-enroll participants into it at the rate of 3%. I think the law says no more than 3%. You've got to cap the account. In other words, once it hits $2,500, you can't continue to add money from that employee into that account. Contributions are Roth-like. The employer, right, plan sponsor, can make a match. And the other rule on that is that the first up to four distributions can't be subject to fees. Now, you can't charge the participant to tap into this. I call it not quite a bank account. It's an emergency savings account that's tied to the plan. So it's an interesting feature. I think we've got another bullet coming out. And by the way, that's not effective until after 2023. Plan year is beginning after 12/31/23. There's another one I think we'll get to today. It's a $1,000 emergency account, which we'll deal with that when that comes up. Okay, so this student loan matching of qualified student loan repayments is a big topic, right? This was kicked off a couple of years ago by, I think it was Abbott Labs that first applied for a private letter ruling to the IRS to try to get this in place. That was granted for them, but as we know, private letter rulings can't be relied upon by other qualified plans or other taxpayers. So this finally made it into the law. It is technically effective as an optional feature, right, for plan years beginning after December 31, 2023. The one thing that I don't want to say surprised me, but surprised some of us a little bit is that the law says that participant students, right, can self-certify the amount of the qualified student loan that they've repaid during the year. So, boy, that sounds great. So it sounds like optionally the employer could adopt this feature for their plan. It simplified one aspect, which was, gee, how are you going to get the data, the information you need to figure out how do you calculate the match? By the same token, it's not without its complexities, right? So if I'm a participant in the plan in 2024, in this example, and I defer 1% of pay and I get a match dollar for dollar, who knows, right? It's dollar for dollar match on my 1% of pay. Then after the end of that year, I notify my employer, hey, I paid qualified student loans during that 2024 year. Now, I'm not telling them that, obviously, until spring of 2025. Because the law says you've got to give me at least 3 months after the end of the plan year to self-report those to the plan sponsor. So now the plan sponsor knows I've repaid the loan. The plan sponsor has adopted that matching feature, and maybe the match is 50 on 6, but you've already given me whatever match within the plan. So you can see there's a calculation of an offset of some sort that might have to be done, right, for certain participants who maybe participated at, let's say, minimal levels in the 401k during the year, and for people who also had qualified student loans that were repaid. In other cases, it'll be a lot easier, right? If that student participant didn't defer into the plan, didn't ever get a regular match in the plan, then the math is probably pretty simple. You take their self-reported student loan repayments, divide it into their compensation, whatever the match formula comp is based upon, and do the math, and then come up with the match. Now, the law also had other relief in there that essentially said you don't have to worry about making those student loan matches coincident with your regular match. So if you're doing it pay by pay, don't worry about it for the student loan portion. It's okay, totally okay to do it later on, well after the end of the year when all that gets settled. So, okay, that's good. It finally made it into law. I don't know how easy that will be, right, if plan sponsors are going to want to somehow coordinate that with their payroll provider, because maybe their payroll provider is calculating a match as part of the normal payroll reports each pay period. So is that something they're going to want to add to that and provide that additional data? are those payroll companies set up to accept that yet? I don't know. Certainly, they're not going to be set up to accept it yet, right? But they may or may not be developing a way or a mechanism to help plan sponsors account for that and do those calculations. So just something to think about if you're thinking of introducing that feature. We're going to go a couple of more slides here. All right. Some of these are, well, I like the second bullet to focus on a little bit. Eliminates required minimum distributions from designated Roth accounts. I'm not sure a lot of people remember or focused on this, quite honestly, but, for 401k type plans that have Roth accounts in them, there was a requirement that you had to take an RMD even though it was a Roth account. That's different from how RMD rules work, for Roth IRAs, right? There was always that discrepancy or that difference. So this really, I think, just cleans it up and essentially brings a Roth account within the plan into parity with a Roth IRA, so to speak. So participants are not going to have to worry about, moving money out of the plan into a rollover Roth to kind of get out of the RMD requirement under the old rules that would have applied. Last bullet on this slide talks about a surviving spouse being able to elect to be treated as a deceased employee for RMD rules. Again, without going into a ton of detail there, essentially it gives relief in some cases, not all, but some cases to surviving spouses or beneficiaries of participants in qualified plans. So again, a little bit of a delayed effective date on that. It's for calendar years beginning after December 31, 2023, after this year is how that one would work. The top bullet is really relief for plan sponsors. This permits a kind of a grace period up to 9.5 months after the end of the plan year for a penalty-free, reasonable correction to certain auto-enrollment, auto-escalation features. In operation and in practice, it's not uncommon to see certain errors in plans that have auto-enroll and auto-escalation. Whether certain participants might have been inadvertently included or excluded. This kind of permits at least a penalty-free. Doesn't mean contribution-free, right? If the employer owes a contribution to those people, that still would have to be done, but at least the penalty aspect of it kind of goes away is the point, and enables plans to make those appropriate corrections. There's a penalty exception, the second bullet here, for withdrawals from emergency expenses. And that, I think that ties into $1,000 threshold, so to speak. So it's interesting that they put a couple of different ways of getting to emergency savings within the plan. The third bullet warrants a little bit more time to think about and talk about. All catch-up contributions to qualified plans must be Roth, except for employees with compensation of $145K or less. So let me say that a different way. If you make more than $145,000 in the preceding year, your catch-up contribution must go into a Roth account. So, a couple of things here. In this new law, they put in an enhanced catch-up amount for participants' age. I think it's 61 through 63. That what they inadvertently did at the same time is eliminate regular catch-up contributions for everybody else in the plan. That's just, I hate to say it's just one of those drafting things, but it is what it is. I think that's going to require a legislative change to fix that issue, because right now, that the way the new law is written, catch-ups are not allowed except if you're 61 to 63 years old. But nonetheless, one of the questions we got from somebody was, hey, I have a highly compensated executive officer of the company, made more than $145,000 last year, but our plan doesn't have a Roth feature. So what do I do, right, with their catch-up contribution this year, right? Because this effective, oh my gosh, this is effective next year. So, but the point is this. They were saying, well, do I put the money in a Roth IRA? I said, no, you really need to adopt a Roth feature in the plan in order to take advantage of it. So it's just one of those things that, you need to be aware. If you don't have a Roth feature in the plan, you should probably add one to the plan. Certainly, if you want to take advantage of making, as I mentioned earlier, matching contributions or other type of contributions on a Roth basis, you need to have that feature in the plan if you don't have it already. Lizzie, that brings us to our second of 3 polling questions, and I'll read it here for the group. The poll is open. So it says 401k arrangements established after what date must contain an auto-enrollment feature. So if the plan was established after 2022, is that the answer? Or is it after 2023, or is it after 2024, or is it never? And we're going to leave this open for a little while. As I said, please answer the polling questions. We've got to get 3 of them in order to get you the credit for this session. And we'll keep that open a little while longer. And again, we're really talking about the auto-enrollment feature that we talked about a little bit earlier today. And if the plan is effective after one of those 3 or 4 scenarios, let us know. Lizzie, how we doing? We getting good results? Most people respond?
We are, and I'm about to close the poll, and then I will share the results.
Okay.
So it looks like 29% said 2022, 26% said 2023, 45% said 2024, and 0% said never. And the correct answer for this would be C, 24%. And Rich, I just want to give you a time check of 9 minutes left.
9 minutes, and we're gonna press hard here. Thank you. So a couple of things on this. If you selected never, which is nobody in this group selected never, that's good, because that's not the right answer. I would also argue that if you selected 2024, keep in mind it's 2025, plan year's beginning in 2025 is when the provision is effective to do auto enrollment. Here might be a little bit of a trick to this question. I apologize for that, but arrangements established after what date? So if you remember, the way the law reads is if the plan was in effect before December 29th, 2022, you're exempt, right? But if it was in play, adopted on or after December 29th of last year, essentially it's got to have that auto-enroll feature in place for 2025. So again, it really is designed to illustrate a little bit of the complexity that I had mentioned earlier on this one. Anyway, so we'll press on from that. We will talk about the middle bullet on this slide, because I already talked a little bit about the top bullet, the enhanced catch-up limit. So there's a feature in the new law that talks about, I call it the long-term part-time eligibility provision. And the current law basically says if a participant has worked at least 500 but less than 1,000 hours during a 3-year consecutive period, they're going to be able to enter the plan. They're going to be required to enter the plan in 2024. The law change essentially says for plan years beginning in 2025, that 3-year consecutive eligibility rule is now a 2-year rule. So again, there's been a little bit of confusion on this one. Some folks were thinking, the 3-year rule is out entirely, and it's delayed another year. Well, that's not the case. The 3-year rule becomes a 2-year rule in 2025, but it still remains a 3-year rule for eligibility, right, for those people in 2020 for the 2024 eligibility period. And again, the other thing this did is extend this feature to 403B plans. So just be a little bit careful with that one as you think about that provision. All right. This slide, all right, the second bullet on this slide, unless the participant elects otherwise, the DC plan must provide a paper statement at least once annually. Defined benefit plans, and this has been in place for DB plans for years. it's got to be once every 3 years or on demand, so to speak, or upon request from a participant at least once a year if the participant so chooses. So again, I'll call these clarifications are in place for plan years beginning after after December 31, 2025. I'm going to talk about the second bullet on this slide, the savers match 50% of IRA or retirement plan contributions up to $2,000 per individual, subject to So basically, this is a provision which where the Treasury, federal government, is actually going to fund a savers matching contribution and actually make contributions directly to the plan or the IRA. Again, delayed effective date, taxable years beginning after December 31, 2026. And I think we'll need that much time to figure out how is the Treasury going to figure out that they need to put money into my account in my 401k plan. Obviously, I shouldn't say obviously, there'll probably be a provision on my tax reform because there are certain income limitations that tie into this. So that's going to take a little bit of time for the government, IRS, whatnot, to figure out how that's actually going to work and how they're going to get the information necessary to be able to make that contribution directly to my plan or my account. So, Lizzie, this is the third and final polling question. I'll read it for the group, and if you can, Lizzie, open that poll, that would be great. So, starting in 2033, required minimum distributions have to commence by what age? Is it 59 and a half? Is it 65? Is it 72? Or is it age 75? And again, I'll remind you, without giving you the answer, right? The government or the Congress, so to speak, has changed the law a couple of times now with changes to the required minimum distribution beginning date, and the old date for many years used to be age 70 and a half, and that was changed at least twice. So, Lizzie, I know you have the poll open, which is fine. If you need to keep it open a little bit longer, that whatever you think is best. And once we close that, we'll give you a summary of the responses, and then just a reminder of the logic that kind of went into this aspect of the new law.
Okay, Rich, I'm about to close the poll, and then I'll read you the results.
Okay.
So these results for 59 and a half, we had 0%, 65, we had 0%, 72, 5% voted that, and 75, 95% voted that. And the correct answer would be D, 75.
Yep, and that's not intended to be a trick question, but who knows what, right? So right now, what the RMD age is, or was, I should say, 72. It's now been moved to age 73, and ultimately by 2033, it'll be moved up to age 75. So, and again, that's one of those things where the government is going to essentially be delaying recognition of revenue, otherwise taxable revenue, that they otherwise would have gotten along the way. So I know let me just do a time check here, 2:58 in my region. So we have to officially go another 2 minutes on this. So I'll just conclude with a couple of things. PEPs, pooled employer plans. There was, I'm going to say something in the original Secure Act that was a little bit, I'll say strange. Those are my words, nobody else's. It required that the plan trustee be responsible for monitoring and collecting contributions and for having a written plan to collect those contributions. And, we always found it a little bit strange because, the trustee of any plan doesn't necessarily see transactions in, participant by participant. They normally see transactions in the aggregate, when the employer makes a matching contribution, or when a contribution encompassing all of the participants' deferrals for that pay period come into the plan. That's what a trustee normally sees. It's normally the record keeper which is not necessarily the trustee, and or it's the third-party administrator, the TPA, that may see those, the distillation of those types of contributions. So we always found it odd that, the trustee is responsible for monitoring, collecting contributions. So anyway, the Secure 2.0 eliminated that rule. It basically said the pooled plan provider may appoint or may designate some other named fiduciary other than the trustee. Doesn't have to be, could be the trustee, but doesn't have to be. And it can't be any of the adopting employers, but it could name somebody else essentially to quote unquote collect contributions. Essentially, that's effective immediately. And that's actually noted relief, because a lot of the institutional trustees in the business, had to essentially have extra layers of oversight and management and expense that kind of went into that part of the process. So that was much needed relief. I'm going to hit on one other aspect on this slide, and then we'll probably conclude here. MEPs and PEPs can include 403B plans beginning after 12/31/22. So again, that's kind of bringing some additional options available for those types of plan sponsors. So with that said, there's a lot of material here in the new law. As I mentioned earlier, I think there's 358 pages of this new law. There were, I think, 92 provisions in total. 90 of them or so are retirement related. Some that we didn't touch on are not necessarily retirement plan related. But it was interesting to go through. It was a long time coming. In many cases, we would have thought this would have been in place even a year prior to the year in which it was adopted, but it is what it is. It's here now. And I think what we're going to see over the next year or two or three, obviously, is a fair amount of guidance that will come out on various provisions, whether it's in the form of rules or regulations or just simply guidance and opinion in terms of how things should work. And that guidance will typically come from a combination of the DOL, Department of Labor, the Internal Revenue Service, and or the Pension Benefit Guaranty Corp in the case of anything impacting a defined benefit plan. So with that said, we thank you for participating today. Hope this was valuable. And with that, Lizzie, I'll close my comments. Thank you.
Great. Thank you so much, Rich, for your time today. And thank you, everyone, for whoever joined the webinar. As a reminder, please complete the survey questions that will pop up on your screen once you close out the webinar, and everyone have a great rest of your day.